All right, so today we're going to be learning the second part of depreciation. So if you guys remember on Thursday, there are only 3 methods that we will be learning, okay? So we're going to be only learning 3 methods, which is activity-based, which is also units of production, and today we're going to be looking at double declining, okay? Tomorrow, we're going to dive right into straight line and we're going to learn a slightly new concept called amortization, which we'll talk about tomorrow. But for today, we're only focusing on depreciation, and it's the second method I want to teach you. It's called double declining. So again, here are the components when it comes to the deciding how to determine the factors that you need in order to start your depreciation. So number 1 is going to be the cost of asset. Number 2 is going to be either the useful life or the estimated life that it can produce. In this case, we're going to be focusing on the useful life. Okay? Okay, not estimated number of units it can produce. It's going to be useful life. Okay? And then third is going to be salvage value or residual value. That is if with the condition that we are using, we're using the privileges that sole proprietors can have, right? We can allow, we get to have the opportunity to take advantage of salvage value. Okay, we get to determine it. And then date of when you place into service. So I'm going to tell you this now. With double declining, you're going to notice that it is very, very time sensitive. Okay? So going back to Thursday's lecture, right? We talked about how an asset, the day that you put it into service, right? We got to determine, is it between the 1st and the 15th or between the 16th and the 30th, all right? And we treat the asset like our kids, right? They only turn a certain amount of age. It's only 4 months old. It's 6 months old, right? That's how we're going to determine the life of this asset and how much we've used so far. All right. And then lastly, of course, it's a depreciation method, which we already know what we're going to be using. We're going to be using double declining. So again, here are the 3 types that we're going to be learning. We've already learned what units of production for. From our conclusion from Thursday is it doesn't matter what time or when you place it into service. All we care about is the capacity, right? Now, let's go ahead and put that aside and let's look at double declining, okay, or also known as accelerated depreciation. Now, what double declining is, what you're going to notice is it is very time sensitive, and the last component is that it needs to equal salvage value at the end of its life. Okay, so what the heck am I talking about? Well, it will make more sense when we move into the actual problem. So double declining method. All right, so here, this is where we depreciate based on how often we use an item. So for example, right, let's say school, right? You never touched a computer in your life, but you decide to buy a computer because you're going to school. You're going to notice that you're going to be using it more often, a lot more than you think you would, right? You're going to be spending hours and hours in the very, very beginning of its life. Once you're done with school, maybe you'll turn it on here and there. Maybe your work requires you to turn it on for like a couple hours a day. But what you're doing is you're utilizing it often in the very beginning of its life. And then as it slowly goes on its years, right, you're going to notice, dang, this computer's getting slower after it's been like, I don't know, 5 years. Oh, dang, this computer's getting slower. I think I need to get a new model. Or I'm not using it as much as I thought I would be using it. So in this case, we're going to depreciate it based on how often you use the item. Okay? So in this case, we're just going to make the assumption that you're more likely to use it way more often in the beginning of the years than you would in its later years. Okay, so good example again would be that laptop or computer, right? Because you're doing it for school, you're going to be using at least more than 6, 7, 8 hours a day, right? So in this case, that's what we're going to be doing. And assets such as computers will be used before in the beginning of its life, okay? So the things that you will need will be the depreciation basis, okay? In this case, the formula are almost identical except they're just slightly tweaked, okay? But in this case, our depreciation basis is completely different. So we're going to think about our beginning of the year book value. So boy book value to be short acronym, right? Beginning of the year's book value. So that means every time we're recalculating this, right, we're going to be taking the value of its book value every single year and we're going to adjust it accordingly. Okay, so that's the only formula that's different. All right, there's actually no formula. You're just taking from the answer from above. Okay, so in this case, all right, so every year is going to be depreciation based on basis changes. Okay, so make sure that you keep a mental note in your head. Every year, the depreciation basis changes. Okay, then we're going to be looking into the depreciation rate. So in this case, it's going to be 1 over its useful life times 2, right? Because we're making the assumption that when we depreciate it, we're going to depreciate it twice as fast. Okay? So in this case, it's 1 over its useful life divided by, times 2. All right? Then the next thing is going to be your depreciation expense, which is pretty straightforward. You're going to take your depreciation basis and you're going to multiply it by the rate. That is standard. And same thing with the accumulated depreciation and book value, okay? You're going to have your previous year's accumulated depreciation plus your current year's depreciation expense. And then lastly, to determine your book value, which is going to also become your depreciation basis, is going to be your cost of the asset minus the accumulated depreciation, all right? And you're going to get that number, and that number is going to be what you're going to be using for your depreciation basis, okay? So let's go ahead and dive into the first example. So example number 1 here, we have record this depreciation for this year, for the first year, okay? So here we have a machine, all right? Its total cost is going to be $15,000. Its salvage value is $2,500, and its useful life is 5 years. It could produce up to 10,000 items, okay? Date that we put it into service is going to be January 1st. So in this case, we have an extra piece of information. We have its numbers that it could produce. In this case, we don't care about how many numbers it produced. All we care is is the time that you placed it into service, but also how many years has it been into service. Okay. So in this case, here we're gonna go ahead and solve for our first depreciation basis, which is going to be the beginning of the year's book value. Okay, so because I'm going to start on year 1, well, what is my book value? It'd be 15,000 just right off the bat, right? Salvage value. Do we care for salvage value? Not this time. Good. But the salvage value will come in handy and come into play when we reach to the end of its life, okay? So in this case, all we care about is finding the beginning of beginning of the year's book value. In this case, we just started our brand new depreciation, so $15,000. 6,000 is correct. All right. So now the next thing that we're going to be looking for is now the depreciation rate. So again, it's 1, like the number 1, divided by the useful life times 2. So can someone tell me what this rate is?
One divided by
So 2.5?
Did you say 2.5?
Yes.
2,
No.
4.4.
0.4 is correct. So the number of useful life it exists is going to be 5 years, right? So what 1 divided by 5 is basically we want to make sure that we have a fraction of time. So this is going to be the number 1 divided by 5, which gives us 20%, right? And with times it by 2, it's going to become 40%. So that is where we're going to determine our rate. Is going to be the number 1 divided by the estimated time, which in this case is 5, and we're going to multiply it by 2, giving us 40%. Okay. All right, now the next thing that we're going to be solving for is going to be our depreciation expense. So in this case, it's going to be the depreciation basis multiplied by the rate. And what do we get here? We're going to get $6,000 as our depreciation basis. So what we're going to do is we're going to take our 15,000 that we started off with, right? And we're going to multiply it by 0.4% or 0.4D if you want to look at it that way, right? So what's 40% of a 1,500? In this case, we solved for it's going to be $6,000. All right, so that's our depreciation expense. Now, what's our accumulated depreciation?
There was no accumulated depreciation because
6,000.
It is 6,000. So remember,
because I'm sorry, I was thinking of the word previous years. So
Uh-huh.
there's a thing. So since this is new, so that's okay. That's what made me say there's no depreciation in the first year.
Yes. All right, but remember it's a formula, so we're going to add the depreciation basis from the current year, which in this case it is 6,000. Okay? Now we need to solve for book value. Okay, so book value is going to be the cost of the asset, which we know what it is, and you're going to subtract accumulated depreciation.
It's
9,000. Good, $9,000. Now, because we've solved for book value from the year 1, so that means when we start off on year 2, we're gonna automatically transfer that number over. So in this case, our book value for year 2 is going to be from the previous that we've solved earlier, which is where that means we're going to start with $9,000. Okay. Any questions in regards to this piece of information right here? Okay, so let's go ahead and solve for the rest of the problem. Okay, so I'm going to go ahead and solve for all of it. So what I've noticed is, my rate is going to be the same thing, right? It's going to be 1 divided by 5 times 2, which we've already solved in the previous section, which is going to be 40%. Then we're going to multiply our 9,000 by that 40% to give us a total of 36,000 or 3,600. Okay? All right. Once we take that 3,600, we need to add it to our previous years of accumulated depreciation, which in this case, so we're adding 6,000 to 3,600. to give us a grand total of 9,600, right? And then we're going to take our cost of asset, which is 15,000, and we're going to subtract the 9,600 to give us a grand total of 5,400. Okay? So any questions in regards to this? So now when we calculate for the third year, we're going to be using the depreciation, the book value of 5,400. Okay? All right?
So that means the rate will always be 40% based on the first year calculation there.
Correct.
So
And
you said that you have it for 5 years, it's going to be 40%, which is almost similar to the other, the chapter 11 itself.
good. So here I already solved for the third year and the fourth year. And what I'm going to notice is that, okay, once I've solved for this, right, I'm going to notice that I have a trend. And you are correct. And I'm going to go ahead and talk about that point in a minute. But what I've noticed is every single time I'm depreciating. What I notice is here that once I do solve for the fourth year, right, it hasn't reached the fifth year. But one rule that stands apart from this is you're gonna notice that boom, I'm at my fourth year. I still have a remaining of 3,240, right? I take another 40%, which now that brings me down to my total book value to be 1,944. What I'm going to notice here is, hold on, what was my salvage value that I had to begin with? What was my estimated salvage value that I determined?
2,500.
2,500. So in this case, yes, you notice a trend. So here, the only thing that's staying constant is just the rate. Okay, but every single column is going to change, right? Your book value is always going to change. Your depreciation expense is going to also change, and then also everything and so on and so forth. Okay, but what you notice here is that your book value is now below the salvage value. In this case, that's unacceptable. Okay, in this case, you cannot ever have a book value that's lower than your salvage value. So here, this is where I was referring to when salvage value does play a role in this calculation. However, the only calculation that you're doing is comparing. Is the end of its life going to be it has to equal your salvage value, okay? And in this case, we haven't even reached our fifth year, and we're already breaking the first rule right here where it doesn't even match our salvage value. And this is exactly where double declining comes into play, because number one rule is your assumption is you're using it more than in the beginning of its life than you are towards the end of its life. Okay? So because we're using it way more in the beginning, you're depreciating it a lot faster. Okay? So it may not last its full 5 years. It can, but in this case, it does not. Because we have a salvage value, and right now, this value has fallen below it. Okay? So what do we do if this value has fallen below it? You're going to actually have to calculate it with its salvage value and work your way backwards in order to solve for the correct amount. Now let's look at the previous one, okay? So in the previous one, we solved, here, let me move that. We solved for the 1944, right? That is our book value, okay? But by using the formulas that we have here, we're going to replace it by 2,500, okay? And then we're going to work backwards, right? So how do we solve for book value? We knew that it was going to be your cost of the asset minus your accumulated depreciation. So in this case, we're going to work backwards. If we know that our ending value for our book value is 2,500 and we started off with 15,000 as our asset cost, we subtract those two numbers and we're going to get now our total accumulated depreciation is going to be now for 12,500. All right. Same thing here. We're going to work backwards again to solve for the depreciation expense because we know what the previous accumulated depreciation was. It was 11,760. So we're going to take our 12,500, right? If we know it's going to equal to 11,760 plus X, right? Because we don't know what our depreciation expense is, right? We're going to take our 12,500 and we're going to subtract the 11,750 to get a grand total of 740 as our depreciation expense. All right? Everything else stays the same because you can't change anything else. So in this case, we're only depleting not even 40%. We're only depleting, I'm so sorry. Depreciating, we're only depreciating less than 40%, even less than 20% at this point, right? Because our value that we used to do was way above that. And if you think about it, we're looking at 3,200, right? And we're subtracting 740. That's less than half that we're depreciating because our value needs to end with 2,500. All right? And that is one rule that you need to stay constant especially when you're dealing with double declining. All right? Any questions in regards to this concept right here? Okay, so again, when we're dealing with double declining, our depreciation basis will always change. It's going to be our beginning of the year's book value. Okay, and yes, again, what you're going to notice is that 40%, once you solve for the rate, it's going to stay the same throughout its problem. However, you want to be careful on every year that you're calculating, okay? Especially when you're getting towards the end of its useful life. So anytime between year 4 or year 5, you want to make sure that you're paying attention so you know that you're not depreciating more than what should be, okay? And once you've reached your 2,500, that's it. You have to stop there. And it's either you either revalue your asset by doing fixtures, or you're more likely to just write it off and either sell off the machine or get rid of it in general. Okay. So anybody confused about this? How we worked backwards? Why we need to do this?
Yes.
Okay. Where are you confused?
It's just, I'm just looking at the working backwards part. I'll get the concept. I'm just going to have to do some studying to understand it.
Okay. So, again, right? Okay, so here's the third year, right? And we notice that our third year is going to start with our 3,240. Okay? We have the rate here, and we solve for the depreciation expense to be 1,296. That's 40% of our asset, right, for the fourth year. I'm going to get accumulated depreciation right here for $13,056. So bringing my book value to a total of $1944. Okay? But because our book value right now is currently falling below my salvage value, I need to replace that book value with my salvage value. Okay? So it can't fall below. All right? So now what I'm going to do is I'm going to replace that 2,500 into that book value. Okay? And if I know my formula to solve for book value is going to be my asset cost minus accumulated depreciation, right? We're already given two variables out of three. So in this case, my accumulated depreciation is what we're solving for. Okay?
So the accumulated depreciation is based off of the, I guess the price that was paid, it was purchased, right? Minus the book value, and that's where you get the, okay.
Yes, so if you this is also simple math. It's called order of operations, right? If you have
Okay.
if you have a few things in place, you're just going to have to move the formula around because no matter at the end of the day, it's going to equal out no matter what it is. So for example, this one, the my formula is book value is equal to asset cost minus accumulated depreciation. We know what book value is. It's going to be 2,500. And we know what the asset cost is, but we don't know what accumulated depreciation is going to be. So if we move the formula around, right, we're going to notice that um, our accumulated depreciation is going to equal my book value, all right, minus, I'm sorry, my book, it's going to be my asset cost, my cost of asset minus book value is going to give you your accumulated depreciation for year 4. Okay, that's just moving the formula around. Maybe I should have had a slide that shows that on how you could convert the formula. So in this case, I have it right here. Book value of asset, right, is equal to 2,500, right? My accumulated depreciation is going to equal my asset cost minus my book value. Okay, so I'm moving my formula around so when I get to one point, I have to work backwards now. Okay, so in this case, to solve for my accumulated depreciation, it's going to be my asset cost minus my book value, which is going to give you here the accumulated depreciation, which in this case, it's 12,500. Okay, now I need to solve for depreciation expense, which we know, right, from the formula of how to calculate accumulated depreciation, right? We just move the formula around. We know that in order to do that, it's going to be the original formula is to solve for accumulated depreciation is going to equal its previous years of accumulated depreciation plus my current year's depreciation, which in this case, we're going to move around and we're going to notice that you're going to keep your accumulated depreciation, right? Because we know what it is. It's 12,500. And when we move it around, we need to subtract out our previous years in order to get our current year's depreciation expense.
So when it comes to the book value
Mm-hmm.
and the the depreciation is less than what the book value is, you just automatically put the book value in there, no matter what it is.
Yes, but it has to be equal to the salvage value. Remember that. That's the rule number one is when you're depreciating your assets, if you have a determined estimated salvage value, your book value can never fall below it. It could go above it, that means you have more room to depreciate, but it can never fall below it. It can never go below it.
So if it falls below it, then you just automatically put the book value as what it is in that section, no matter what it is. So if
Correct.
the book value was 3,500, you would just put 3,500 in there and then calculate the the current and previous accumulated depreciation and put that over in the expense.
Okay.
Does
Book
that make sense?
yes,
Okay.
that's correct, but it's not book value, it's going to be salvage value. Okay, so
Okay.
your
So what
salvage
I want,
value has to be placed in there.
oh, got you. So the salvage value is the book value, right?
Correct, correct. It has to be at the end of its life. And in this case, it never made it to its fifth year. Because
Okay.
the concept of using it so much in the very beginning of the year, right? We're depreciating it faster. We're depreciating it twice as fast than normal. So your assumption is because you're using your okay. So for example, a printer, right? Its capacity is it could produce like I don't know 1,500 pages, right? But if you're constantly printing it so often in the very beginning of its years, right? So for example, I was printing out classwork schedules every single day. Now I don't use it as often. So if I were to depreciate my asset, right? Oh my gosh, you have no idea how much I use that printer to the point where all its ink I had to replace it twice. But now that I replaced it, I don't even touch it at all. Most cases because we're moving online now. But in this case, right? That's what I'm trying to say. The example is you're using your printer so much in the very beginning of its life, right? Or maybe you bought the printer to do school. So you're using it, you're exhausting its capacity, right? You're making it shoot out a bunch of paper. And then once school is over, you don't touch the damn thing. You don't touch it at all. It's just maybe you'll print out, a plane ticket here and there, or maybe a list of things you want to do, or grocery list, whatever you print out, right? Maybe you'll print out every once in a while. So that's what this concept is. You've used it so much in its beginning of its years, you can already assume that it's not going to last long. Okay? Um, Okay, so again, that can apply to any electronics that you would know that you're going to use it more often in the beginning. So, for example, right, a cell phone. You're once you get the latest and the greatest thing, you're going to be using that more constantly. You're going to be dealing with, using all of its applications. You're going to explore on what it can do, right? But once you get used to it, now and then it just becomes okay. It's I only need it when I have time for it, right? Does that concept kind of flow in like you're going to depreciate it faster because you're using it so much in the beginning of its life?
For me, it's not even, I understand that concept. I think it's for me, it's just the formula and making sure I remember the formula. Because that for me at the end of the day, when it comes to this whole course, is just remembering the formulas and how to apply them properly.
Okay, so in this case, just understanding that we depreciate it a lot quicker, right? The one rule that must stand is that if you establish a salvage value, because again, sole proprietors get that leniency, they get that opportunity to be able to depreciate it to depreciate it to its salvage value. We get to determine the salvage value. So with that being said, that means we have a cap on how much we can depreciate the item for. And in this very concept, your book value can never exceed your salvage value. It must be equal at all times at the end of its life. And in this case, its end of its life is on the fourth year because of the concept of utilizing so much, depreciating twice as fast. So in this case, we've reached our end of its life. It fell below salvage value. So what we have to do is we got to fix it so then it looks like we didn't depreciate that much. And again, this is most likely going to happen on a month-to-month basis, not a yearly basis, just because it just makes sense. Why would you look at your machine a year later to calculate how much you're depreciating it? Most likely, if you're using this asset constantly in the beginning of its years, you're more likely to do this every month to depreciate it. So you'll find it a lot quicker than waiting until year 4 to finally adjust it. But again, I want to make this very simple and easy for you guys. So here, again, it's the same exact formulas except we're just moving its components around. All right. All right. Any other questions that we have here? Again, this will make a lot more sense when we move into the exercise and start practicing it over and over again. No questions?
No, I'm fine.
Okay. So for in your case, it's just memorizing the formulas. Okay. All right. So again, here you're gonna notice that it never reached its life, right? Because again, it was short by 1 year, or in this case, it's probably short half a year because the way that we depreciate it, right? But what we're gonna notice is our depreciation basis will always be the beginning of its year's book value. So again, this number always changes. But what you're going to notice is that this rate is going to stay constant, right? It's going to be whatever number that you saw for the very beginning, it's going to apply all the way down. Okay? And then lastly, one concept that needs to stay true is your book value is equal to salvage value. Okay? So we went kind of quick through this because I was thinking like, okay, well, when we do calculations, it's pretty straightforward, right? You just apply the formulas. But the one concept I wanted to teach you is what happens when you reach the end. Okay? So now let's go ahead and journalize this. Okay, so here is the journal, and at the end of its first year, what did we calculate? So I have the table down here below. So my depreciation expense for year 1 was $6,000. So how do I journalize this?
Depreciation expense.
Good. Depreciation expense is your debit. And what's my credit going to be?
Accumulated.
Okay. Good. And just like what is in your table, right? Year 1 is $6,000. Therefore, $6,000 is going to be your depreciation expense for this year. Okay. All right. Any questions in regards to journalizing? Journalizing is the easiest part. Calculating can be difficult if you do get stuck. Okay. All right.
So we may journalize the way that we did for the other depreciation.
They're all the same. They're all the same throughout the entire thing, right? It's just a matter of how you calculate it.
Gotcha.
Okay. It's very similar to inventory, right? It doesn't matter what costing method that you use. You're going to produce one type of answer, and the journal is going to look identical throughout. Okay. Same thing with what is it? Bad debt expense, right? It doesn't matter what method of calculations you use, the journal will always stay the same. Okay. So yes. Okay. Here's the example for second year. Obviously, it's pretty straightforward, right? Second year, we're going to determine the same accounts. But this time, instead of putting $6,000, we're going to put $3,600 because that's what happened on the second year. Okay. And then, so again, every year the journal entry will look the same. Will look different. Okay. And the only thing that's different is just the number that you're going to be doing, okay? So, with that being said, as I mentioned before in the very beginning of the lesson, right? One thing that you need to understand is depreciation for double declining is time sensitive. Okay? So again, I'm going to go back real quick, right? To this page. It's time sensitive right here because again, it doesn't, the life that it has, the life expectancy is going to be a lot shorter. Okay, so by you placing it into service at a later date, you need to consider its rest of its life, because again, we have the assumption that its life expectancy is going to be short. So this is where you applying partial years is going to come into play, right? It's very time sensitive. So in this case, on October 1st, a machine was purchased for $10,000, and its useful life is 5 years, okay? And its capacity of producing 25,000 units, okay? It has a salvage value of 2,500, and at the end of its life, okay, the machine was placed into service on October 14. Okay, so in this case, if we are placing it in October 14, what is our assumption we're going to do? When do we start depreciating it?
Month of October.
Yes. So here I've already placed it in blue for you guys because it is October 14th, right? It falls within that concept of the falling between 1 and the 15th. So therefore, you need to depreciate the month of October, right? Because that's more than half the month. You need to depreciate it. If it's less than half the month, then you need to depreciate the following month. But in this case, we fell right before the half mark. So in this case, we need to depreciate for the month of October, November, and December, assuming that you do the depreciation at the end of the year. Okay? So in this case, because knowing that very concept right here, let's go ahead and solve for the depreciation basis, the depreciation rate, expense for this problem for the first year. So what's the depreciation basis?
10,000.
10,000, okay? What is the rate going to be?
%40.
40%. Good. So 1 over 5, which gives us 20%, times 2, which gives us 40%. Okay? And then lastly, what is my depreciation expense for this problem?
4,000.
It's going to be 4,000. Okay? So here we know this, right? But this is solving depreciation expense for one entire year. What is the one thing that we know? Did we actually depreciate it for the full year?
No, because it started in October.
Exactly, no. We are not going to use that depreciation because this depreciation is for the whole year. Okay? So now we're going to have to go back and think about it. We have to depreciate October, November, and December. How many months of that? How many months is that? 3. And how many months are in 1 year? 12. So we need to calculate 3 out of 12 months. In this case, that's 1/4. Correct?
Yeah.
Okay, so what we're going to do is we're going to take that $4,000 and we're going to simply
Divided by 12.
not divide it by, okay, go ahead. That's fine.
I was calculating them times 3.
Good. That is one way that you could solve for that as well. All right. So what she did was she took the $4,000. She divided by 12 because that's going to give her every single month's worth of depreciation expense. Then she multiplied it by 3, which gives you, because that's what we solved for. We're solving for only 3 out of the 12 months. So in this case, what did you get, Lynette?
999.99. So
99.99. All right. Another way that you could solve for it is by taking the $4,000, right? And we know that if 3 divided by 12, 3 divided by 12 is going to be 25%, right? 25% of the year, or also known as 1/4. So what you could do is you could take the $4,000 and you could either divide it by 4. You can also multiply it by 3 divided by 12. Okay, so 4,000 times 3, okay, divided by 12 gives you $1,000. Okay, so for yours, Lynette, you did do a little rounding error, right? Because you had that 3.333333, right?
yeah.
So in this case, you would round it to 99.99, which you can't have 99, you can't have 0.99 of a month.
Mm-hmm.
So therefore, you need to round it to 1,000. So in this case, this is what we did. We took our depreciation expense. We either divide it by 12 and multiply by 3, or you could just simply figure out that 3 months out of 12 is equivalent to a quarter of a year, or even 1 divided by 4. And then you could multiply it across, and you're going to get $1,000 worth of depreciation expense. Okay, so does this make sense on how we calculated this? Okay, so this is another thing that you need to memorize as well. Okay, so the $4,000 is my total annual amount that I'm going to be depreciating for one entire year. Okay, again, is my asset a year old yet? No, it's only 3 months old. Remember, it's like a baby, okay? It was born on October 14th, so therefore, you need to calculate October, November, and December. It's only 3 months old. Okay? So, in this case, we're only depreciating a partial of its years, okay? And then this is going to apply across as well, because that means the depreciation expense is going to change again because of its book value, right? Because of its book value. So in this case, the accumulated depreciation is going to be 1,000, and then you're just going to subtract it, right? So when we start on your second year, it's going to start with $9,000, and you're going to just rinse and repeat after that. Okay. And then, yes, so in this case, you only need to solve it for one time. The beginning of its life, and then when we reach its book value, you need to adjust the ending. So you got to trim the beginning and you got to trim the ends. But in the middle, right, once you start from January all the way to December, that's one full year of its life. That's when you can go ahead and say, okay, that's one whole year, which is going to be for whatever amount that it is for one whole year. Okay. Any questions in regards to this particular section? Okay. Anything? No? No questions? Okay. So again, October plus November plus December is equivalent to 3 months. Because we solved for one whole years, we need to adjust it, because we're not going to depreciate the asset for a whole year. It's only 3 months of it right now. So that's what we gotta do. Okay. And then same thing, journalizing is pretty straightforward. So in this case, we're going to journalize the first years of depreciation. So I'm going to be looking at, what's my account going to be?
Depreciation expense. for the
Mm-hmm.
credit,
Mm-hmm.
account depreciation for the credit.
Good. And it's going to be for $1,000.
1,000.
Okay. Assuming that your depreciation is going to be at the end of the year. Okay. Good. All right. Any questions in regards to this chapter at all? Because that is it. So here is going to be your formulas that you need to be memorizing. Not memorizing because I allow you to take this sheet with you, okay? So you guys can have it with you at all times and just be able to just calculate and fill in the table as needed, okay? All right. So any questions in regards to the formulas and why this has to happen? So again, so this is the definition of double declining is you have the assumption that you're going to be utilizing it in the beginning more in the beginning of its life than it is at the end. And one concept you need to know is your book value must always be equal to your salvage value. Can never be less. Okay. So let me see what time it is. So right now it is 9:27. So let's go ahead and complete the exercise real quick and then we can call it a day. All right. So if you guys haven't done so, go ahead and pull out your chapter 11.2 double declining exercises. Okay. All right. So here, all right, your first example is you purchase a cash register for $300 with no salvage value. So it has zero salvage value. Okay. Its useful life is 5 years. And it can print up to 5,000 receipts. All right. You place this cash register into service on January 8th. Okay. So let's go ahead and fill in our information right here. Okay. So what is my asset going to be?
300.
No, my asset. What is my
The
asset?
is the cash register.
Yes, it's a cash register. Okay. How much is my total? What is my asset cost going to be?
300.
$300.
It is going to be $300. So $300. Okay. And then lastly, what's my salvage? I mean, not lastly. What is my salvage value?
0.
It's $0 because we claimed zero. Okay. And then what is its useful life?
5 years.
It is 5 years. Okay. And lastly, when do we place it into service?
January 8th.
January 8th. Okay, so in this case, when do we start depreciating it?
January.
January. So in this case, I'm going to treat it as if my depreciation expense is going to happen at the end of the year. Okay? So what is my depreciation basis going to be for my first year?
300.
It's going to be 300. Okay? All right. What's my rate going to be?
Okay, not 40%.
Yes, it's going to be 1 divided by 5 times 2. Okay, so I get 40%. And what I'm going to do is I'm going to apply that all the way down. Because I know at this part of my formula, this is going to stay the same. Okay. Okay, so what is my depreciation expense going to be for the very first year?
120.
So 300 times 40%, which gives you 120. All right. And what's my accumulated depreciation going to be?
120.
It's going to be 120. And my book value is going to be
180.
okay, it's going to be 400 F 4. All right, subtract 300. 120 is going to be 180. Okay, so then what do we know about this 180? What do we know about this 180?
It becomes your depreciation basis?
It's going to be the second year's depreciation basis. So here is going to be like that. So 180. Okay. Now what is 180 times 40% again?
72.
And you said 72?
Yeah.
Okay. So let me see if my formula. Perfect. 72. Okay. What is my accumulated depreciation for year 2?
That's a formula again per unit times. I don't have the formula with me.
Okay. It's going to be your previous year's accumulated
Previous year.
depreciation, which is what? 120. You're going to add
Oh, yeah. Okay.
So it's 192.
192. Good. Okay. And then in this case, what is my book value going to be for my second year?
That came from passive asset.
108?
108. Good. So it's going to be the cost of asset, which is 300. You're going to subtract the 192 to get 108. All right. So then therefore 108 is going to be my beginning of the year's book value. Okay, 108. Okay, let's go ahead and do this calculation again. Now we're on year 3, or the end of year 3, right? What is the depreciation expense for year 3?
I got 43.20.
$43.20. Good. So then what's my accumulated depreciation going to be for year 3?
235.20.
$235.20. Okay, and that's going to give me a book value of
64.80.
$64.80. Okay, so then that's going to again be my beginning of the year's book value here. Okay, and then what is 40% of that? Or what's my depreciation expense for year 4?
25.92.
$25.92. And then what's my accumulated depreciation here? 261.12. And then lastly, what is my book value for year 4? 38.80. Okay? Notice. Let's look at the book value. It started at 180, then it dropped to 108. Then it dropped to 64, then it dropped to 38. Do you see how it's just dividing almost in half every single time? Okay. Now that we reached 38.80, so then what is my book value? What's my depreciation basis going to be for year 5? What is my depreciation basis going to be for year 5?
3888.
38.88. And then what's my depreciation expense? 15.55. And then lastly, What is my accumulated depreciation here?
276.75.
276.75.
Yeah.
What is 12 plus 55?
261. Oh, I have 20. I have 261.20 in my accumulated the previous year.
Okay,
I'm sorry.
no worries. So in this case, I have 276.67. And then lastly, my book value is going to be
2333.
23.33. So notice in this example, right? Because we have no salvage value, this can go on and on and on and on. Even it this for this kind of sense, it could go beyond its 5 years because we have our salvage value is not even 0. Okay? So in this case, this is where it's one of those things where you have that dusty old laptop for 10 years, right? You can still turn it on. Is it going to produce you any work, any productive work? No, but you still can use it and you can turn it on. So that's what this concept is, right? Because laptops, you already know, their lifespan can be anywhere from 3 to 5 years, right? So that's the example I'm using. It could still turn on, it could still open up your applications, but it's just going to be really, really slow. And that's what this is, right? It's going to go on and on and on and on and on. Okay? But in this case, I just want you to cap it off at 5 years because that's what its capacity has told me. Its capacity has told me that it's supposed to, it should be, its life should give up around 5 years. Okay? All right? But with this example, right, you can always do fixtures to it, right? Once you've reached that 5th year and it's already $23.33, you can upgrade your computer, right? Or in this case, it's the cash register. You can upgrade the cash register, right? Maybe get maybe get it fixed, tweak it here, maybe clean it up, get all the ink spills out of there. Maybe replace some of the buttons that you've, smashed in. So in this case, I mean, honestly, you've used the crap out of it. It's good already. So I mean, as far as taking a loss for $23, I think that's okay to do. Okay? So in this case, it's still lasting us for a long time. All right, so question 2 says, let's journalize the depreciation for the first year. So what is assuming that the end of the year is December 31st, okay? So what is going to be my journal here?
Depreciation expense 120 debit
Good.
and accumulated depreciation.
So hold on, depreciation expense and accumulated depreciation. Okay, and it's going to be for 120. Good. Okay, what about for my second year? I think it's the next question. Yeah, what about the entry for the second year? So here, I'll go up again. So what?
The same depreciation expense and accumulated depreciation.
Good. But for what amount now?
72.
For 72. Okay, so here's year 2. Okay, and this time it's going to be for $72. Okay. Good. Any questions in regards to how we solve this particular question? Okay. If we were to go expansive or extensive, right? Let's say there is a salvage value at I don't know, at, let me think, at $40. Then that's where we're, once we hit this $23, or when we hit that $38 on the 4th year, we're going to have to go back and fix it, which in this case, we'll go ahead and take a look at that in the next problem. Actually, well, the next problem is going to be monthly based. But what we can do is we can create a scenario where that's the scenario. Okay. So here is example number 4, or question number 4. Example 2 for this. So in this case, you purchased a computer for $1,988, which includes all fees, okay, with a salvage value of $200, okay. Its useful life is 5 years. You put this computer in service on August 25th. Assume that adjustments are at the end of the year. So let's go ahead and plug in our information here. Okay, so in here, what is my asset?
Computer.
Computer. Good.
Asset cost is 1,988.
Good. My asset cost is going to be $19.88. Okay. Good. What's my salvage value going to be? What's my salvage value going to be?
200.
200. What's my useful life?
5 years.
5 years, okay? And the date that placed it into service?
August 25th.
August 25th, okay? Now, notice that in this case, so notice that this case, right, we have a salvage value and we have a, what do you call it? Partial years, okay? So we're gonna, okay, so because we established it in August 25th, what does that mean? Can we depreciate that month? Can we depreciate for the month of August?
No.
No, because it's already past the half mark. There's no point to depreciate it. So we're gonna depreciate for September, October, November, and December. So how many months is that?
4 months.
It's 4 months, okay? So let's keep that little thing on the side, and let's go ahead and solve for this table here. So for the first year of depreciation, what is depreciation basis going to be?
The purchase amount, 1988.
1988, okay? And then what is going to be my rate?
$795.20.
Hold on, before we got there, what's my rate?
Oh, 40%.
Okay, good. So 1 divided by 5 times 2, which gives you 40%. And in this case, we know that this is going to stay the same all the way through. Okay? Now, my depreciation expense, what did you say it was, Adina?
I said $795.20.
$795.20 is going to be our depreciation expense for the first year. Now, this is for 1 whole year.
Yeah.
That's right. So we have to
You have to calculate the monthly.
You can divide it by the monthly and then multiply it. In this case, what do we know about we have 4 months out of 12.
So 4 divided by 12.
4 divided by 12. You can multiply across, right? You can multiply it by 4 and then divide it by 12. You can also divide the whole thing by 3 if you know that 4 and 12 is also known as 1/3. Okay. So in this case, the 795.2, okay? 795.2. What do you want to do with it? Do you want to How are we going to calculate 4 months total of this asset?
4 divided.
265,007.
26507. Okay? So if you saw my formula, I went ahead and just multiplied it by 4 and divided by 12. Okay? You can do that. Or let me see, you can also do 795.2 divided by 3 and you still get the same answer. Okay? So here, go ahead.
When you divide it by 3, is that because you're doing quarters?
Yes, so 4 divided by 12, right? You can simplify that to 1/3, correct?
Which is point 3333333.
Correct. Correct. I mean, if you want to punch in all those numbers, you could do that, but in this case, I can just go ahead and just divide the whole thing by 3.
Okay.
Right? So you don't have to multiply by 3 because you're going to get a rounded answer, right? In this case, I can go ahead and just simply divide by 3.
So what if it's 5 months? Do you just divide it by 5 at that point?
No, because 5 out of 12 is not going to be 1/3. What is 5 out of 12?
That's what I'm asking.
Okay, so in this case, no, you cannot apply it because it's 5 out of 12, right? So what we were looking at is 4 out of 12. 4 out of 12 can be simplified to
How do you-
1/3.
My question is, so like divide, that 3 is one thing, but then say for example, instead of it being 3 months out, it's 5 months out. How do you come up with the equation to be able to calculate correctly?
Okay, so in this case, what was it? This much, right? If we were to, let's say hypothetically it's 5 months, right? You could just multiply by 5 and divide the whole thing by 12.
Okay, is there a simpler way, or no, that would just be the best way?
This would be the best way because just because what is it? You don't have to deal with decimals, right? And especially you don't have to deal with those extra long numbers, right? You don't want to have to deal with that long number. And this is going to be giving you the best accurate number because if you were to do, if you, let's say on the side, right? I did 5 divided by 12, right? If I know what 5 divided by 12 is, it's going to be this long number right here, right? So that's 5 months out of 1 whole year. Okay? Now because
or that when it comes to calculating, when you do have that odd number of months that you have to calculate, that I calculate correctly to get the answers that I need.
Okay.
So I just want to make sure I had that particular formula down.
Okay. So that particular formula, right? It's just, again, since we're dealing with partial years, if you'd like, go ahead and create a spreadsheet so then it indicates to you, right? How much is this month? How much is that month? How much is this month, right? You could do what Lynette does, right? Where she divides the whole thing by 12, right? So you get a monthly amount and you multiply by how many months there exists already. That's going to also get you the same answer.
Okay.
Then
So
you just
honestly, at the end of the
multiply.
day, it's just as long as you understand what you're calculating. So in this case, I'm calculating only 4 months out of 12. And if I think about it, 4 months out of 12 is 1/3 of a year. Just like 3 months out of 12 is a quarter of a year. So I'm just taking one step to just simplify it. But in this case, I can just directly place it in here. So example right here. So what was it? It was 795.20. I can go ahead and just write 4 out of 12. I don't even need to take that extra step to think up that this is 1/3. I can just go ahead and straight away just type in 4 months. That's how many months that the asset was depreciated for, right? That's because my asset's only 4 months old. And I'm going to just divide it by 12 because that's how much out of 1 year I'm actually calculating. So in this case, I just type it in straight away as 4. Okay, you multiply it by 4 and you divide the whole thing by 12. And you should get the same exact answer, which is 602.6507. Okay, so in this point, how you calculate it doesn't matter whether you calculate it as a fraction, as a decimal. As a decimal, it will matter because you don't want to punch in all those extra numbers in your calculator. Not saying that you can't, or you can divide the whole thing by 12 to get a monthly rate. Then multiply it by the months that you did calculate it for. And then you'll get the same answer. Okay? So again, that will be something that you want to look into. I think the easiest and the most productive and proficient way to do it is just simply multiply across with the number of months that it's been depreciated for, and you're just going to divide the whole thing by 12. That's the easiest way I would recommend you to do.
Okay, well, easy. Appreciate it.
All right. So what is the accumulated depreciation for the first year?
265.
Good. 265.07. And what is going to be my book value now?
I got $1,722.93.
$1,722.93. Yes, good. All right. So what's my depreciation basis going to be for the second year?
1,722.
22.
Good. And then we're going to multiply this by 40% to get what for my second year?
Okay, there we go. Get calculate again.
That's fine.
What'd you get, Lynette?
I just calculated for the year. It came six.
No.
No.
Go
I
ahead.
got 6,917.
Something.
Oh, whoa. My formula did not go through in this case.
2.93 times 40%.
Okay, so what did you guys get?
I got 689.17. That's what I got.
Good. Okay. Okay. So, Lynette, did you get the same answer?
No, I was just calculating. I'm sorry. I didn't get the answer. I didn't.
Okay. What about Mia, Vina? Did you guys?
I got 689.17 as well.
Good. So, now, why is this number you don't need to add or you don't need to create that second formula to calculate the X amount of months that it has been depreciated? Why?
Because on the first year, you already have the actual depreciation of that 265. So it is already based from the blue book value that 1722 would be for the basically calculated for the no, I'm sorry. No.
Okay, good try. Now, what's the difference between the first year's and the second year's depreciation expense? What's the difference between them?
The
Is it
amount
very
first,
Well, sorry. What was that?
is it because the first one was only based on 3 months of the year? Is that what you mean? Or you subtract 689 from 265?
No, just like you said it. Said it exactly. It's because the first year we've only calculated, and it's 4 months, right? It's September, October, November, December. It's 4 months. It's only 4 months old at that point.
4 months?
But because we're assuming that when we start depreciating from the beginning of the year, right? Because at the end of the year, we depreciate it. And so every December 31st, we're depreciating it. So in this case, from January to December 31st, it's reached its full year. Yes, is everyone following me?
Yeah, yeah.
In the very beginning, we place it in its we placed it in service on August 25th. Now we're not counting from August 25th to the next August 25th. No, because then if we do that, then our depreciation should be for August 25th. But in this case, we are just doing our journal as if it's at the end of the year. So December 31st. So the first year of its life that we've calculated from January to December, right? We know the first year that we placed it in was only from September, October, November, December. So that's why it's 4 months old. And now that we're starting from January all the way to December, we can safely assume that now it's been depreciated for one entire year of its life already. But we know that this asset is 1 year and 4 months. Okay? So let's go ahead and solve for the accumulated depreciation for this one now. So we're leaving this at 689.17. So what is my accumulated depreciation going to be?
954.24.
954.24, yes. And then what is my book value going to be?
$1,033
One-
76.
Good. $1,076. So then my my depreciation basis is going to be for the third year. It's going to be from there. Okay, so what's my depreciation expense? So let's go ahead and solve for the rest. Okay, so my depreciation expense is going to be
413.50.
400 and did you say that?
413.50.
14350?
Oh, are you talking about the accumulated? Because I was looking at the depreciation expense, which is
Depreciation was 413.50.
Okay. All right. Okay, so now what's the accumulated depreciation?
Go, Lynette. You got it?
1367.74.
Yep. And then what is my book value going to be?
So I got confused with the calculation there. I'm sorry.
620.25.
620.26. I got 26. So 24.
Not it round.
That's a figure I got, but I wasn't so sure with the calculation. I'm referring
Okay.
to my notes. So
Okay. Well, here, let's look at our accumulated depreciation, right? So 954.24 plus 413.50. Okay, what's 24 plus 50? That's for sure going to be 74 cents. That's for sure going to be 74 cents. And in this case, we have 620.26. So if we add those two numbers together, it should give you an even number of 1988. So this is correct so far. Okay. So then if we have that going to be my depreciation basis for year 4. Okay, so now I'm at 6/2026. All right, what is my depreciation expense for year 4?
248.10.
248.10. Okay, and then lastly, what is my accumulated depreciation here?
I came at
1615.85.
1615.85, and my book value is going to be
372.15.
372.15. All right, so that's going to be for my 5th year. All right, and what's my depreciation expense going to be for year 5?
148.86.
148.86. And what's my accumulated depreciation going to be?
1764.71.
1764.71. And then lastly, what's my book value going to be at year 5?
This year. Okay.
Did you get this answer?
Oh,
223.29.
Perfect. Okay, so let's go ahead. Okay, so we know that we've reached our end of the year, and one thing is we are within the salvage value, right? Our salvage value needs to be at 200. So let's go ahead and do a potential one. Let's say potentially on year 6, right? I'm going to make this in bold so you guys can see this clearly, that this is just an assumption. Okay, so assuming that you continue its life to year 6, because again, you can still have it working beyond its years. So in this case here, my book value is going to be $223.29. So what is going to be my book? I'm sorry, my what is that, depreciation expense for year?
89.32.
And what's my accumulated? 1854, or I'm sorry, 1850.
1854.03.
03. So 2 plus 2 plus, oh, you're right, 2 plus 1 is 3. So 8403, you said? 1 plus 2, yes. Okay. And then, so what is going to be my book value now?
It's less than the 200.
Boom.
It's 133.97.
Okay, so boom, it is supposed to be 133.97. And what do we know? What do we have that you need to make sure that this stays true?
That it shouldn't be lower than the
Book value. But let's also look at this. How old is your asset?
it's 6 years.
Well, is it truly 6 years?
No.
Okay. So
5 years.
before we even calculate our 6th year, right? How old was our asset? Before we calculate the 6th year, how old was our asset?
5 years and 8 months?
Technically,
No.
it'd be 4 years and 8 months, right?
Oh, okay.
That's what I was calculating. Yeah.
Yes. So
Yes.
its capacity, can it go for another year? In this case, no. So that's our assumption there, is because it's gone. It's already getting, it's well used, and it's slowly dying. But in this case, we've only calculated before we had the 6th year. we've only calculated 4 and 8, 4 years and 4 months. So it's still got 8 months left to go. Okay, so that's just a little assumption there. Second thing, number one thing that we should have recognized here is we fell below our salvage value. So now let's calculate this so then it matches our salvage value. So in this case, we cannot calculate 133.97 anymore. It needs to be what? What number does this value need to be?
Well, real quick, Lynn,
Mhm.
that's off by a penny. So I don't know if that, I'm not sure if that matters. It probably does. It's supposed to be 1854.02.
1854.02.
Depreciation. It's off by a penny.
How did you, why? You got 71 plus 32.
Well, I'm looking at, because I'm doing Excel, so I'm looking at depreciation was 223.29, rate was 40 times that. That was 89.32.
89.32. 89.32. Mm-hmm.
And then when I did the formula, it was F16 plus E17, and that came up to 1854.02.
That's what I had originally, but if you look at it by solid numbers, right? When you journalize this, can you do a tenth of a penny or a hundredth of a penny? In this case, our numbers are supposed to be rounded. But in this case, these numbers don't matter because what are we going to be doing? We're going to have to adjust it no matter what. So, yes, I did recognize that too. And that's why I changed it because 71 cents plus 32 cents, there's no way that's going to give you 2 cents. Because 1 plus 2 is definitely not 2. It's 3. So I recognize that. But at this case, this doesn't even matter at the end of the day because we're going to have to change it. We're going to have to adjust it. Okay. All right. So here, what is my book value supposed to be?
200.
It's supposed to be 200, right? Okay. So let's follow back our formula, right? So how do we solve for book value? What's my formula to solve for book value?
Depreciation basis.
No. We're not solving. We're not doing depreciation basis for the 7th year. I'm asking you, what is the formula to solve for book value?
Oh, cost of asset minus accumulated depreciation.
Okay. Out of those, what numbers do we have? We actually have the book value, so we know it's equal to 200. Okay. Now my accumulated depreciation obviously is what I'm solving for. But what is my asset cost originally?
1988.
So what I'm going to do here is I know that this is going to change, right? So it's going to be 1988 minus the 200, which gives me my total of $1788 worth of accumulated depreciation. Because I just took the formula, I rearranged it because I have 2 components out of the 3. Now to solve for x, right, or the mystery number, you're going to rearrange it so we know that we have the asset cost. We know it's going to cost me $1988. And at the end of the day, my book value needs to be 200. So I took my asset cost minus my 200 to get me to 1788. Okay. Now,
Okay.
go ahead.
Well, will you like? Because I know that you didn't put that, on the PowerPoint. Are you going to put that somewhere so when the exam comes up, we'll know exactly how to get the number?
Um,
Because we're gonna need that.
I yes, I could adjust the PowerPoint if you'd like. I can do that for you. The only thing is, it's gonna take some time. So
Or just create something where it's like, okay, here is, you don't necessarily have to alter the PowerPoint, but you just create a single page just to let us know what that formula is so that when we do the exam,
mhm.
we'll have.
Okay. So on your
Just like
answer
what
sheet, on your
just
answer
like what you
sheet,
did on the answers, the calculation from the chapter 11, the first year,
That's
first
what I was gonna say.
okay, I'm sorry.
On your 11.2 answer sheet, it's going to be the word formula. It's going to have all the formulas that you need. And
Okay,
I do just like as is. I type in the formula, and then right after that, I do the calculation. So it's all going to be there.
perfect.
All
Thank
right.
you.
Yeah, of course.
Question.
Yes.
Where did you get that book value of 200? I'm sorry, that's what I'm trying to calculate. And same thing with the previous when you were showing the PowerPoint presentation. So,
What's your
what was the
salvage
base?
value?
Oh, okay, that's what your basis is.
Mm-hmm.
Okay, okay,
Book value should always equal your salvage value at the end of its life. Okay, you cannot go below it. You can go above it, but that's if you want to. When you're done with your asset, are you going to sell it? Are you going to get rid of it? What are you going to do with it when it reaches fifth year? In my case, I'm going to just try to depreciate it as much as I can. I'm going to keep the asset because it's still working, right? And in this case, what is this? A computer? The computer's still going to work. So, but in this case, now that I established that my salvage value needs to be my book value, needs to equal my book value, that is where I pulled that piece of information from. So here, my book value is now my salvage value. Okay, now I'm working backwards to solve for my accumulated depreciation, which in this case is 1788. Now, by looking at the formula to solve for accumulated depreciation, what do we know? What's the formula to solve for accumulated depreciation?
the depreciation basis minus,
Nope, nope.
which was the original asset cost, which
No,
is,
no, 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 no.
oh,
Accumulated depreciation. I'm looking for accumulated depreciation. What is the formula for accumulated depreciation?
The
Previous year.
previous years,
Uh huh.
Go ahead. Go ahead. You got it.
go ahead.
the previous year's accumulation plus the current year.
Correct. So in this case, we are solving for our current year. Okay? If we do a little simple math here, so we have our accumulated depreciation, we have our previous years. So in this case, my formula is going to be my so it's going to be my accumulated depreciation minus my previous years to get my current years. And in this case, it's $23.29. Did someone can you someone calculate that for me?
24 even. I came up 24 even. Oh, no, no, no.
24
No, no,
even?
no, no. I'm sorry. I'm sorry. I, I put,
You forgot the cents.
yeah, yeah, the cents. Mm, 23.29.
Okay. Good. So in this case, we're assuming that on its sixth year, right? Meaning the asset is now 4 years and 3 months, right? We're assuming that on the sixth year, it's going to depreciate for the rest of its life, which is the remaining 8 months. So in this case, it's now 5 years old. So this is what I'm going to depreciate it by $23.29 to get me an accumulated depreciation of 1,788 to get me a grand total of my salvage value to equal my book value of 200. Okay. All right. So let's go ahead and journalize for the first year. So what is my journal going to look like, and what is it is the amount?
Depreciation expense is debit 265.07.
Okay, hold on. I'm going to copy and paste the information from the previous one. Okay, so okay, good. So okay, so depreciation expense and accumulated depreciation. Okay,
It's 265.07.
26507. 26507. All right. And the same thing is going to occur on the other side. 26507. Okay. And then for question number 6 here, record the adjustment for the second year. So in this case, what was my second year?
689.17.
689.17. 689.17. So I'm just going to cell reference it because I don't remember it. So here, 689.17. And therefore, you need to have your equal and opposite credit of 289.17. Okay? So in this case, we just go ahead and we just went ahead and practiced this section right here. So again, the answers will have the actual formula, how to solve for that formula, and so on and so forth. Okay? Any questions in regards to the exercise at all and the chapter itself? So this one is actually a lot more difficult because you're going to have to memorize book value is the depreciation basis. Okay, now book value needs to equal salvage value, so I have to work backwards. Okay, so this is one of the harder concepts. Okay, tomorrow you're going to love straight line because it's the easiest. You don't need to think at all when it comes to straight line. Okay. Any questions in regards to today's lecture?
No, ma'am.
All right, again,
Yes.
with further ado, we're going to practice this again on Thursday. Wait, today is Wednesday. We will practice it on Wednesday. Okay, so just stay tuned.